Gentlemen, welcome to the crypto channel 329. Today's video is going to be about OTC and non-OTC currency pairs, okay, or trading pairs. All right, so if you come over here to the currency pairs, we can see that we got stocks, cryptocurrencies, commodities, etc. Okay, and we can see that some of them have the name of the pair, and they have OTC, and others they don't have OTC. So if you actually do this, we can see the ones that with the highest payout, they usually are OTC. So stocks, you can see the majority of over here stocks, they are all OTC. Commodities, some of them are all OTC, and currencies, some of them are OTC. Usually the OTC, they have higher payouts, and whereas the non-OTCs, okay, as you can see right here, there is non-OTC, no OTC right here, they have lower payouts, okay? So I'm going to explain to you the differences between them. And also the payouts vary. Sometimes, these non-OTCs could be like 36% payout, and sometimes, depends on the time that you are checking the markets, the payout could be like 50, 60, or even 92. Sometimes you see super high APRs. Okay, so for example, like this one right here, non-OTC, we got 90% payouts. Okay, it depends on the time that you check the markets. So I have this word right here with explanation about the OTC market and the non-OTC market. So the OTC market is like a private marketplace where two people can trade securities directly with each other without going through a middleman like a stock exchange. OTC markets are less regulated than stock exchange, which means there are fewer rules and less oversight. This can make OTC markets riskier, but it also gives traders more flexibility. Yes, that's true, because with OTC market, you can trade at any time, whereas this non OTC, you can only trade at certain times. So for example, if you come over here, we can see that these ones, they're not available at the moment. Eventually, when the market opens, excuse me, the market opens, these pairs will be available. But right now, because the market is closed, they're not available. So if you come on Saturday and Sundays, all these ones non-OTCs will not be available because the market will be closed. Okay. And also, again, like I said to you, the payout is greater because it's OTC, is less regulated, so it's a lot riskier. Okay. Whereas the non-OTC market is like a public marketplace where everyone can trade securities through a central exchange. Okay, stock exchanges are the most common exchange in the non-OTC markets. Non-OTC markets are more regulated than OTC markets, which means there are more rules and oversight. This makes non-OTC markets safer, but it also makes less flexible. Okay, like I said to you, if you want to trade if you want to trade Saturday and Sunday or out of hours, these non-OTC pairs will not be available. And here's a simple analogy, okay, just to make it simple and make it easy for you to understand non-OTC and OTC. So imagine you are going to buy a used car. You can go to a dealership, which is like a non-OTC market. The dealership has a central exchange, central location. I'm with this market right now. The dealership has a central location and a variety of cars to choose from. You can also be sure that the cars at the dealership have been inspected and are in good condition. Okay, this is like going to the non-OTC pairs. Okay, they are regulated, so there are rules in place, so you can guarantee that there is no manipulation. Okay, well, nowadays crypto and forex exchange are highly manipulated, but it's less manipulated than the OTC market. However, you can buy the same used car from a private seller, which is like an OTC market. This can be cheaper, yes, that's true, than buying from a dealership, that's correct, but it's also riskier. You need to be careful to inspect the car yourself and make sure it is in good condition. Those are the differences, and this is a really good analogy for you to understand the differences between OTC markets and non-OTC market. Which ones I prefer? If I could choose, I would go to non-OTC all the time, but the non-OTC all the times, they have less payouts and they take longer for the trade to develop. So for instance, a few minutes ago, I was looking at this one, I was expecting the breakout, but nothing, a dump out, but nothing happened, okay? And it takes more time for the trade to develop, okay? As you can see right here, the price chart doesn't move as fast as this OTC pairs, okay? This one moves a lot faster than the non-OTC, okay? So things that you have to keep in mind. So sometimes with non-OTC pairs, I add more time for the trade to develop, whereas the OTC pairs, usually I go for 1 minute, 1 minute, 11 seconds, because the trade eventually will be developed by then, okay? But yeah, in regards to trading, it's up to you. So if you like the risk, you know, go for OTC. Make sure you do your proper analysis before you jump in a trade. And OTC, they will have a higher payout, but it's not more volatile. Risk less payouts. Well, not less risky, still risky, but less payouts and the less chances of being manipulated. Okay. Because it's regulated and they got rules in place and everything else. Okay. That being said, guys, I hope you guys have a better understanding now about the OTC and non-OTC pairs. So if you still got any questions, let me know in the comment box below, and I will get back to you as soon as possible. Peace.